Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right. I am super excited about our next guest, Mr. Devin Elder. He's with DJE Texas Management and is a principal with that company. It's his company. So he's going to talk a little bit about some of that, but just an amazing guy. He's got one of the few people I know. I've traveled with him and Amber to Belize in his plane, which was freaking awesome. Great experience. My first experience going private. And then had an opportunity to eat some barbecue with him out at the Salt Lick, and we left San Antonio in his helicopter. So just an amazing, an amazing guy. So anyway, Devin, welcome to the show. Appreciate you joining.
Keith, awesome to be on. Thanks for having me, man. Good to catch up. Looking forward to it.
Yeah, absolutely. So I wanted to see maybe if you can just give for our listeners, kind of your background, what got you into real estate, and then we can end up with some of the current things that you're doing.
Yeah, for sure. I had a trajectory, I guess, for my life and career. Kind of grew up. I was actually homeschooled early on. Went to public school in 6th grade. Went through high school. Graduated high school. Went to UTSA. In high school, I started playing guitar, and I thought I was going to be a professional musician. And I actually did end up being a professional musician in the sense that I made money playing music. So I would sing in these bar bands and do that kind of thing while I was in college, and I had a lot of fun doing that. And even for a couple years after college, I was like kind of a quasi-entrepreneur. Like I didn't have a job. I played music for a living. I would bartend one night a week to help supplement and pay bills. I had this college degree, but I was like, in my 20s, and I was like, man, I don't really want to kind of give this up, because it was a very liberated lifestyle. Even if I wasn't making much money, I did control all my time. And I think that kind of stuck with me. So taking it way back, and I'll keep this short, but I think from birth and going to homeschool and having that freedom experience, and then kind of having it taken away from me going into public school in 6th grade, was always this formative experience. And then I feel like in my 20s, having this experience of being an entrepreneur, I call it entrepreneur. I sang in a freaking band and play guitar, but
hey, it's about as entrepreneur as you can get, right?
Yeah. I mean, I booked all the gigs and made all the money and sang for my dinner and paid my bills that way. And I was proud of that. I lived in a house with 2 other guys. We had, our rent was like a couple $100 each. Yeah. So expenses were super low, but I guess my point with that is that was another kind of experience of a massive amount of freedom in my life that I got to experience again. And I was like, I really, really like this kind of level of freedom. Then as I'm getting older, getting further in my 20s, I'm seeing everybody around me get jobs. I'm seeing like, okay, I'm not going to move to LA or New York and, basically be homeless for the next decade. I think that's kind of what it takes to make that dream happen for people. And, you hear about people that have gone on to have successful music careers, putting hundreds of thousands of dollars on credit cards, living on top ramen for years. I mean, I'm a firm believer that kind of commitment is what it takes. And I wasn't willing to do it. So I got a job, ended up getting a corporate job, which I really liked. It was a really good company at a really good phase in that company's, evolution. And I really enjoyed that for a first handful of years. At the time too, I'd met my now wife. And so things were like, okay, I got to start thinking about these things a little bit differently. And then, fast forward a couple of years now, got our first son. And so kind of wife, family, like these responsibilities coming on by choice, but just growing up and going, all right, so I got to get a job. So that's kind of what led me to the corporate career, and really enjoyed that for the first handful of years and really gave it my all. I was, totally gung ho about it and trying to get promoted and trying to, work as hard as I can. I've always worked hard. I've always had 2 jobs, whether it was, bussing tables when I was 16 and going to school or working all through college. I've always worked a lot. And so I applied that to the corporate world. And after a handful of years, I just started to realize that I didn't have any heroes in the corporate world. And so I was looking at guys, my boss's boss and stuff like that, that I just didn't see a path forward for me. Even if somebody's making a lot of money, I think it was back to that kind of freedom component that was missing. So at that point in my corporate career, started reading books like Rich Dad, Poor Dad, Tim Ferriss' 4-Hour Work Week, which I think is kind of silly, but
right.
It was motivating. It's kind of silly, and it's big on ideas and very well written to get you fired up, but those things kind of planted a seed. And I remember being a kid and homeschooled and having that freedom. I remember being in my early 20s and having this freedom of not having a job and just kind of singing in a band to pay my bills. And so I started exploring ways to develop passive income, and I didn't know what it was going to be. I thought it might be, some kind of online business, had no idea, had no concept of real estate. I bought a book in Kinko's once called Building Wealth One House at a Time. And I read it and I just thought, this guy's crazy. He's buying houses and putting renters in there. Like, that sounds bonkers. But you start researching passive income and wealth building, and kind of all roads lead to real estate. People have either made their money in real estate, or they've made their money somewhere else. They're a professional athlete, or they had a corporate exit, or they sold a company and they put it in real estate. So, we talk to a lot of our investors now that they've had successful exits somewhere, business or corporate career or whatever it was. And now they're like, what do I do with this capital? So it kind of all finds its way to real estate. So that's what I did. And it started with going to a weekend course, signing up for a $10,000 mastermind program, and doing my first deal a month later. So kind of a long and winding narrative on my, whole life up to kind of doing my first deal. So I'll stop there and see if you want to kind of, dig in, or if I can explain any of that.
Yeah. I was going to ask, what kind of work were you doing in the corporate area? And then, I think that was one of the questions that I had.
Sure. Yeah. So I started out as an entry level, salesperson at an IT company. So I actually, I did have a college degree, but this company was pretty rigorous on their hiring, and I would say kind of hard to get into at the time. And the VP of, worldwide sales I knew him from him coming to see me sing in a band.
Oh,
so
really?
yeah, he
awesome.
kind of total random. I think without that connection, I would not have been hired there, even though I had a, college degree and stuff. So I feel like he kind of got me in there. I think he saw some kind of potential in me, which I proved him right on. I ended up being top performer in sales and moving up the ranks there, and then getting into marketing and some other roles within that company. And then kind of over about a decade corporate career, ended up doing sales, marketing, sales leadership, some software stuff, like some CRM type stuff, operations type stuff, working on some apps and things like that. So pretty broad experience kind of in the corporate world. And I am thankful for all of it. I remember developing for some financial models for a sales team that I was a part of, that I could instantly see this impact of this financial model, or developing some CRM stuff in a bigger organization and seeing the impact. And I definitely have taken that skill set into my own companies, and I'm really grateful to have those things. But, for an entrepreneur, I think I was never, I just ended up in sales because I thought, hey, I'm I don't mind talking to people, and that comes natural to me. And there's potential for upside here on the money. I didn't really ever think about it, but looking back, it's so critical, I think, the sales component for any entrepreneur to have. And honestly, I tell my kids that, like, if you want to own your own business, like go get a sales job and start there.
Yeah, exactly. And even if in Rich Dad, Poor Dad, Kiyosaki talks about that as well. I mean, how important it is. And, you hear that, whether you think you're in sales or you don't, you're in sales of some sort.
Yep.
And so, having those soft skills is important. So how about the mastermind? Yeah. What is that one that's still around, or what was the mastermind that
Yeah, it is. I won't name it just because I've, ended up leaving and being, kind of unimpressed with some components of it. So I won't get into that, but I will credit that with, I think, kind of this mechanism that happens when you, my brother says, when you pay money, you pay attention. And I think me putting up $10,000, which at the time was some serious cash.
Right.
And I just kind of made a deal with myself. Like, I'm going to see an ROI on this capital. And it really made me kind of buckle down and pay attention. And I think there's so much content out there, and there's so much education, and there's so many people that, want to pick your brain or get coffee. And it's like, people value what they pay for something.
For sure.
And so I'm not saying just go spend money on a mastermind just to do it, but there is kind of this effect that happens where if you are paying money for some kind of mastermind group, and I'm in several now today that are different ones, but I'm in a CEO peer group that I pay for. And then I'm in another group called GoBundance that I'm happy to talk about, that obviously, you've heard a thing or two about as well. So
right.
I'm a proponent of getting in the right rooms. And so, back to your question about the specific mastermind, I won't get into the details of that, but I will say that was a turning point for me in my life to say, hey, I'm done with college, but I'm not going to stop learning, and I'm not going to stop paying for education, and I'm not going to stop paying for shortcuts if I can get them, and paying for relationships, or paying to be in the right room with people that are doing bigger things than me. More than anything, that's had the biggest impact on me, because we're just social creatures. It's monkey see, monkey do. And whatever room you're in, you're just going to start to pick up those habits, good or bad. And I absolutely found that to be true. So I'm a big proponent of masterminds and paying for coaching and paying to be in, the right groups.
Yeah, I think it makes a huge difference. I can remember even in my own career as a real estate agent, one of the best things that one of my managers did for me is he saw some talent and he said, I'm going to pull him out of being in this office with a bunch of new people. And he threw me in an office where there was an extra space with 3 top producers. And, just to see the difference in what they do throughout their day than the newer folks, there was constantly on the phones, hammering the phones, and just you can't be in that room and not feel like I better pick up the damn phone. It's one
right.
of those that just, and so it's just kind of the same thing in the masterminds as well. You're just seeing people that are aspiring for things that, quite honestly, are kind of inspirational to you as well. It works well. So with that, what did that catapult you to do in real estate?
Yeah. So I think most important, well, there's twofold. One, just tactically, I started buying houses, and I remember my first house I bought with hard money. It was a $40,000 purchase with a $10,000 rehab, which I thought was like, oh my gosh, $10,000 rehab, which is funny because we'll do like $3 million rehabs on projects today. And I don't bat an eye, right? I kind of chuckle at that. That first deal was like $10,000 a rehab. Incredible. But the whole BRRRR method, right? Which your audience may or may not know, but buy it, renovate it, rent it out, and refinance it. And hopefully on the refinance, you pull out all your capital. I did that. I think I still had $8,000 left in the deal, but I was like, holy smokes, man. I joined this course. I got this guy that was coaching me through it. I did what he said, even if it sounded counterintuitive. And then, a couple months later, I had this asset with equity that was cash flowing. And I just remember thinking, I wish somebody would have showed me this in high school. I'd have like 100 of these things by now because I didn't start doing real estate till I was in my 30s. So that in the mastermind, learning how to do houses. Yeah, I didn't really start with much capital. So to be able to buy these houses for between 0 and 10,000 out of pocket, man, I could start to string a few of those together. But at the same time, also being around guys that had 1,000 doors of multifamily. To me, that was just absolutely instrumental in my trajectory because I got to experience their peer pressure on me. I'm like, hey man, when are you going to buy 100 units? And I'm like, that sounds preposterous, but they seem to think I could do it. Yeah. And it took several years of being around that environment, being around these people, also building capital. I mean, multifamily takes a lot of capital. So two things, tactically just buying houses and going, wow, I just increased my net worth by 25,000. Now it's net worth, it's on paper, it's not liquid, but that's 25,000. Like that, for sure. And I could see myself going to do 2 of these and then 10. And I'm going, now this is a really like a job killer, right? And so I'm looking at my job going, how long is it going to take to make $250,000 net worth in my current job? Like it's going to take a while. So, right. Started doing the houses, spent 2.5 years working a job, actually changed jobs with the intention of that being my last job, kind of took an easier job that wasn't quota bearing. So I could just kind of get a paycheck, which I didn't love. I didn't love being spread so thin, and I felt like I was kind of phoning it in at work. And I still, I feel bad about that. But, I showed up, did my job, and it's in my nature to, I think, kind of always keep going and kind of be insatiable about things. So to just like show up to work and punch in and kind of get by and leave was like, yeah, I didn't like it, but it was all in service of this kind of bigger goal of building financial freedom. So I would go to houses in the morning. It's at 6:30, check on houses. I'd go to work. I'd leave for lunch, go sign documents at Starbucks with an escrow officer, buying a new house, selling a house, go back to work. Then after work, I'd go check on a house again. And so I did that for about 2.5 years, and it was pretty, it's super intense, man. Super hard, burn the candle at both ends. But after that, I build up enough cash flow, cover my bills, and quit my job. And that's when the companies really, really took off.
Yeah, that's awesome. Yeah, I love, Jim Rome has a saying to work harder on your fortune than you do on your job. And you can see that in the transition, and certainly it's paid off for you. So, so you quit your job, and then where did we go from there?
Yeah. So I had kind of this baseline, of experience now, having done like a lot of house. I mean, I'd done a ton of loans at this point. I think I had 22 units, a 6-unit multifamily. So my first multifamily, which I bought when I still had that job. I'd flipped some houses, and then I had a portfolio of rental houses, which were producing enough that was producing enough cash flow. And, I really worked hard to build that portfolio, and it hit my trigger, which was I need to cover my bills with my passive income, and then I'm going to jump. And so it had been 2.5 years of just planning and plotting and working hard and setbacks and getting back after it, and just kind of being relentless about this target that I was going to get free. I always kind of liken it to Shawshank Redemption. I mean, it was hard. Looking back, it's easy to kind of forget about it. Right. But man, it was hard. And it was, chipping away at the tunnel with the little rock hammer, right, is what it felt like. In retrospect, 2.5 years, not a long time. I mean, if you look at getting a college degree or some other worthwhile endeavor, but it's super hard. So, but my thesis the whole time was, okay, if I had all my time and energy, because right now I'm spread pretty thin. I'm married. I have 3 kids now. Wife doesn't work. I have a full-time job and a real estate portfolio. Like, I was working hard, which I've always done, but I'm like, this is not, not sustainable, but it's also hurting the business now. The job now is hurting the business. Like the opportunity cost of going to work was becoming higher and higher. So the thesis was, if I had all my time and energy to put into this business, which has already proven some success, like it wasn't an idea at this point. I already been through a lot of transactions. I thought, I think I can scale this up. I have one little multifamily. I've been studying multifamily for several years now at this point, meeting people, talking about how to raise capital, touring properties, building relationships with guys that had bigger portfolios, seeing how they did it. and just planning and plotting and scheming and building my own portfolio. So that was the point. Left the job and pretty quickly started to scale up the multifamily stuff after that. So there's a 75 unit that I partnered on with 2 other more experienced sponsors.
Okay.
And then after that, it was kind of off to the races. 130 units that I bought as the primary partner with one other partner out of Boston who raised some of the capital and helped me with the balance sheet. But really, other than that, was sort of hands off. So it was kind of me running that deal, and having success in that deal was like, all right, I'm a multifamily guy now. And so after that, it was 100, that 130 unit, we bought 128, then a 250, then a 400. It just kind of off to the races since then. And so we've bought thousands of units at this point. We've gone full cycle on a number of them, and then more recently have expanded in the last couple of years into some other asset classes, which I can talk about. But I think the trajectory was a period of 2.5 years of working really hard, learning the business, building a smaller portfolio, building cash flow, then getting to that point where, okay, I'm going to leave the job and focus all my energy on it. And that's when things really kind of took off. And that was also simultaneous with going after bigger assets, right? It kind of got to the point where I was like, I could have 300 doors of single family. I mean, I've got a process, I got a system, but the thought of that was like, I can't live like
right.
I don't care how much money there is. I can't live like that. So getting to these bigger assets was a way to have fewer transactions and just much bigger deals happening. And then also coincidentally starting to syndicate capital, raise capital, and go bigger and do deals through that avenue too.
When did you start that piece of the puzzle, the syndication?
I like to say it was like 6 houses in, where I was using hard money lenders that, I'm paying 13, 14% to and 2 or 3 points. So like really high rates, but I had access to capital.
Yeah. Right.
So that was like, shoot, man. And the numbers work. So I would do it. I put together a nice presentation. I was presenting it at a meetup and like, hey, I've done these houses. Here are my returns. Here's the projects, blah, blah, blah. And, a guy in the audience is like, hey, I could lend you this money. And I was like, what do you mean? What are you talking about? I'd never heard of private lending. And he's like, yeah, I do some private lending. And I was like, okay, what's that about? He said, well, I'd give you money at 10% and 2 points and I'm easier to deal with. And I thought like, okay, let's do one. So couldn't believe the guy was going to give me 150 grand or whatever. Obviously he's tied up in a first lien and, he's pretty well protected, but that was new to me. And that was like this light bulb going off of, wow, okay, I can use OPM, other people's money to do deals and make it a win-win for everybody. So that I like to call that kind of my first investor, even though he's just a lender. We ended up doing millions of dollars of deals. And then I kind of took I'm always trying to leverage the track record, or I was in the beginning, to say, I've done these. Now I've done it with a private lender. Maybe there's another, doctor or dentist or somebody in my circle or friend of a friend. Maybe they'd be interested in getting double digits on their money and I could show them my track record. So I started to build this little handful of private lenders and did that for a couple of years on some of these house projects that I was doing. And that's what allowed me to build my confidence to take other people's money, because that's a huge, daunting thing. It ought to be a huge, daunting thing. Exactly. Taking other people's capital. So I had a lot of practice for a couple of years on smaller projects. Every one of them went well for the lender. I had a couple that did not go well for me,
right?
But lender wouldn't even know it, right? Always paid my stuff on time. If there's a couple deals that I kind of squeaked by or maybe lost a few $1,000 on, which, you would have been better off staying in bed than getting up that day to buy that house. But lenders were always squared away. And so because of that, I kind of built, a handful of relationships that for that first multifamily deal, 75 unit, I was able to go to this group and say, hey guys, you've seen some of the house projects that we've done. They've gone well. Well, I have a bigger project now. And, it's a little different. It's a syndication, it's equity, but I think the payout's a little higher than what you're used to seeing from me. We think we can get a 20+% return on this deal.
Yeah.
And that worked. And so that was my first syndication. And after I kind of got my legs under me with syndications, we just kind of kept growing it. I think one of the things we talk about internally with my company, which is, 80 employees now, is, being a company that is highly referable or easy to refer. So we really don't we don't have any marketing. You know, I have a podcast, which is kind of organic marketing, I guess, but really we want to have such a good experience for that investor that puts $100K with us that they go tell their neighbor. Yeah. And we don't talk about that with investors necessarily, but that's what we're talking about internally. How do we make it such a good experience? There's a book by Daniel Priestley called Oversubscribed, which just talks about this concept of the thesis of the book is you take your marketing budget and you put it on your customer experience. You already have customers. Like getting a new customer is really expensive and difficult. You already have customers that ostensibly like you. Focus on them. And so that's kind of been the way we set up the company is how do we focus on the investor experience, make it amazing to the point where somebody would refer us without us asking. And that's kind of the standard that we're shooting for there. So that's grown the investor, base, massively over the years, just kind of through referrals, which is any business's best, best kind of way to grow their customer base.
Yeah, sure. And what about, as far as, on these initial ones that you purchased, is that all in, I know you primarily focus on the San Antonio area. Is that kind of been true throughout your entire career, or what does that look like?
Yeah. For the multifamily stuff, it's all been San Antonio. I'm a passive investor in a lot of deals, some of which are not in San Antonio, but those are truly like LP passive. I just write the check. Yeah. Right. So, but hey, I'm an owner, tiny fractional owner of stuff that's outside San Antonio. But if we're buying it and operating it, it's in San Antonio. Now that we have a bigger team and we own the property management company and everything, we could expand to other markets. We're trying to buy 3, 4, 5 multifamily deals a year. And so far, we've been able to find that in San Antonio. Now, you and I are talking in Q2 of 2023 right now. The debt market, interest, we're about a year into an interest hiking cycle. So acquisitions have slowed down for everybody, nationally. But in normal times, we're trying to buy 250, 300, 400 doors a quarter. And historically, we've been able to find it in San Antonio with so many home court advantages. I could just go on and on and on and on that I don't have in Fort Worth, in Dallas, in Austin, in Houston, in wherever. So also, selfishly, one of the reasons I kind of want to get out of the corporate world is I would see these sales guys that made really good money, but they were like gone half the month. And I just decided right from the get-go, I wasn't going to have a job where I was gone for my family half a month. Unless I'm gone, with them. We'd probably travel half a month now, but we travel
That's
together.
Right.
So a little different. So that was... we've been able to do it in San Antonio. We have expanded to other asset classes, some of which are outside San Antonio, but the multifamily stuff has been here. And, we may expand in the future. I wouldn't rule it out, but it's a whole lot easier when it's something that you can just go tour like right now, be over there in 15 minutes.
Yeah, for sure. And just the experience of living in San Antonio for as long as you have, and, just knowing, it's sometimes hard when you're looking at a city outside of your expertise. I mean, in general, Dallas is a great market, but there's little pockets that, probably aren't the best neighborhoods and that you wouldn't, consider purchasing in. And so obviously you do your due diligence on any of those, but still, I mean, to know the market like the back of your hand is nice.
For sure. It's home court advantage. And that's one of them, is just knowing like, hey, that side of that street is no go. The west side of that street all day long. It's like, it's so nuanced, right?
It is.
And then even to the point now, I've been in the business for a while where it's like, every asset, right? It comes up, you go, oh yeah, that's John's deal. Yeah, I know all about that. They had a fire 18 months ago, and I know the regional manager who runs that deal, and one of our maintenance guys that works for us used to work over there last year. I mean, it's like, that's all of it. So it's kind of funny. It's like at this point, we're just seeing deals we know come back around.
Yeah.
Like, oh, we hadn't looked at this one in 2 years. So let's see if we can get it to pencil this time around. It's kind of funny.
Yeah, that's cool. That's really neat. What, if you don't mind talking a little bit about what else you have. Obviously, you got the apartments, but what other asset classes are you into?
Sure. Yeah, we love the apartments. And we're really geared as a company to run, B and C class multifamily. It's just that it takes a lot of work to find one. And so as we were building the company and building our expertise internally, which is really fantastic, right? Because you're gonna pay for it. You're either gonna have a third party, which is gonna be much more expensive, anything, right? Accounting, property management, acquisitions, whatever, or you're gonna have it in-house, which is gonna be lower cost, but now you got kind of a payroll burden. So as we started building the company out, I'm like, we don't want to be forced to buy a multifamily deal just because we have overhead. So, what are some other asset classes we can get into? And several years ago, we ended up buying a family ranch, and the broker was smart. I mean, I just called him off a listing he had on a ranch. He said, "Hey, that one's gone, but I got many more. Let's go. Let me take you around in the truck. I'm going to show you some ranches." And so he drove me around, me and my son, for 3-4 hours around South Texas, showing us ranches off a phone call. I'm like, this guy is putting in the work, man. I mean, I'm just some guy that called him. But he's smart, right? Because of that, we kind of built a relationship. We got to spend 3-4 hours together. So instead of just being some guy on the other end of the line that I could ignore his phone calls, okay, we kind of built a relationship. We ended up buying 150 acres south of San Antonio. I absolutely fell in love with it. It's one of my favorite places to go with the family or with my boys, or with buddies. Go out there on the ranch and, shoot guns and hunt and camp out and cook and have fires and shoot fireworks and, ride the four-wheelers around and stuff. I mean, it's the best time. So I kind of fell in love with this whole ranching thing through having our own ranch. And then a couple months later, I'm talking to my broker and I'm like, could we buy one of these things? Could we buy 300 acres and chop it up into 100-acre tracts and sell those to guys like me? And he said, yep, absolutely. So we tried a little one. It made money. We tried another one. It made money. And then I went to Justin, who runs our investor relations. And I said, you think investors would want to buy some ranches with us? And so we launched it. Investors liked it. And we kind of haven't looked back. We've bought thousands and thousands of acres now around Central Texas using this kind of wholesale retail model. We'll buy 500 acres, chop it up into 4, sell them off. And just by virtue of doing that, you're selling at a higher price per acre. So credit to my broker who runs this. He does an incredible amount of due diligence on the front end. I don't want to make it sound like this is easy. And, he's looking at hundreds of deals for one to make sense for us. But from my perspective, owning and running a multifamily investment company and a property management company, I'm like looking at the land going, this stuff is easy by comparison.
Right.
So not to take anything away from my broker who is, literally sending the skid steer out there to cut trails and run power. And tremendous amount of work, not to mention all the work buying it and selling it. But for him, he's got a client in us that pays cash, is easy to work with, and he gets both sides of the sale. And I'm telling him, hey man, we want to buy $50 million of land this year. And he's like, okay, I can build a business around that. So he's built up his team around that, to just buy and sell ranch deals. And, it's been a really cool relationship. And, the bonus is we get to, fly the helicopter out there and go hunt these ranches. A couple weeks ago, my son got out of school, picked him up, flew the helicopter out there in the middle, halfway to Lubbock, middle of Texas, and went and sat in a ground blind, hunting turkeys, and just super cool stuff like that, as kind of a bonus on some of these investments. And then a good return to investors. We're paying 11% to investors, but it's debt. So there's literally no bank loan. It's a first lien, low leverage. And I think the investors recognize that, okay, it's 11%. Maybe a multifamily deal is going to pay 15, 20, 25% annualized return, but I'm in an equity position. I'm behind the bank. And this could be, 3, 4, 5 year project here. Whereas the land, we're saying, hey, we're in and out in a year. It's actually, I'm taking that private money model that I used to do all those houses where I'd pay my lenders 10, 12%. And they would lend me the money to buy and fix and flip the house or fix it up or refinance it. I'm just applying that to ranch land. Same thing, kind of same old tricks I've always been up to, same old game I've been playing for years, just applying it now to bigger ranches that scale easy. And I was talking with my broker. It's kind of funny. You could buy a $500,000 piece of land or a $20 million piece of land, and the business model we're doing, same thing. You know, he was telling me, you know, that this is like 2 years ago, that the top sale in Texas or Central Texas, you know, this gigantic ranch. He's like, guess what they're doing? I'm like, they're doing what we're doing. And he's like, yeah. So
Wow.
scale's kind of all the way up, and certainly not a new game, but we've enjoyed it and it's been super fun. And I just love the whole ranch world and everything about being outdoors and all that stuff. So that's kind of the ranch division, which is an important part of our company and gives us kind of some deal flow if we don't have a multifamily deal. You know, we don't want to start laying people off if we go 9 months without doing a multifamily deal. And we don't want to start buying subpar deals just because we've got payroll overhead. So having other avenues for the company at our size and our expense load has been really awesome. And so I call it, you know, 3 legs on a stool. We've got multifamily land, and then we've got these industrial, what I would call light industrial contractor garage type product that we really like, that we're building. And that's kind of the 3rd leg on the stool. And depending on what the economy's doing or interest rates or whatever, one of those legs on the stool might be easier to buy or a bigger focus for the company. But because we've got 3 legs on the stool, it's really helped our company sort of survive and thrive through COVID, through interest rate hikes in 2022, through whatever we've seen over the past couple of years. We've been able to, you know, not shrink as a company, not lay people off, not go through this whiplash. Even if the economy's whiplashing, we've still been able to kind of have consistent deal flow because it's different product types. And so that's been a real blessing for the company. And, you know, like I said, man, if I could buy 300, 400, 500 doors of multifamily every quarter, we would absolutely do that. But if we can't find it, we've also got some land deals. We've also got some industrial deals, kind of keeping the deal flow alive.
Yeah, that's really neat. What about if you can maybe share, you mentioned earlier in our conversation about some of the deals that you've exited. For somebody who maybe hasn't done one of these before, can you talk a little bit about annualized returns and then also multipliers? If somebody invests, you know, I don't know what your minimums are, if they're 50 or 100, but you know, if somebody invests, what is obviously, you know, there's no guarantee and all that good stuff.
Sure.
Yeah, just some examples maybe.
Yeah, I think it's important to talk about. I could kind of put it in 2 buckets, right? One bucket is debt, one bucket is equity. And I'll do the debt one first because it's just kind of easy to understand. At this point, hundreds of debt projects we've done. We've always, you know, whatever we said we were going to do, we've always performed on that. And usually that's kind of that 10, 11% annualized return. So somebody puts in $100K, they're earning $10,000, $11,000 in a 12-month period on that. And the debt's pretty easy to understand because it's kind of like that private loan, you know, loan us $150,000 to flip this house. I'll pay you 10% annualized interest, 11%. So we've got hundreds of projects, full cycle, land and kind of smaller single family stuff. So, you know, I'll call that 10, 11% return. And that's debt. So there's, you know, if the investor's in on that, whether it's one investor or several, they're in it on the ground floor. There's nobody in front, there's no lender in front of them. So your risk profile is a little better and your return is a little lower because of that. Then you get the equity side where you usually is pretty much always the multifamily for us, where you got a bank loan and then you got equity on top of that. Those returns, we've always targeted 17% average annualized return, which if we say 5-year hold, that's a 1.85 equity multiple. So 100,000 turns into 185,000. But really the one metric I'm looking for in multifamily or when we're taking on equity is 17% average annualized return. Now, you know, deals that we've gone full cycle, we've hit 18, we've hit 25, we've hit 30% on actual, you know, full cycle deals.
Yeah.
And we've overperformed on some of those, but that doesn't mean that's always going to be the case. But we're trying to get deals to underwrite at 17% average annualized return. And so, you know, we're never going to be in a deal exactly 5 years. So I like equity multiples fine. You know, I look at a million different kind of investments from different sponsors and stuff. And, you know, if somebody says equity multiple of 3, oh, triple my money, freaking sounds awesome. Okay, but over what time horizon?
Right.
10 years. Like, oh, geez, 10 years. Like, So I don't really care about equity multiple as much without the time component. And that's why the single metric I like best for investors, for me as an investor and to show investors, is average annualized return, which, is a cousin of IRR. We can get into IRR. That's actually a relatively complex formula. So I like average annualized return because it's super simple to calculate and explain in 2 seconds to people. So to answer your question, on the equity side, we're looking for that. I just tell people 15 to 20% average annualized return on the deal. And our decks and stuff we send out, we say 17%, just because we like to keep things consistent. We've always done 17%. And so that's kind of been our target. And then on the debt side, it's usually 10 or 11%. All the multifamily stuff we've gone full cycle on has overperformed, but those have been in kind of some lower cap rate markets too, right? So right now with our current portfolio, we're just kind of operating. We would entertain sales on stuff where we'll hit that 17%. But if we're not able to hit that because interest rates are higher or whatever, we're just going to continue to operate for another year or two and see how markets are. And that's kind of been our thesis all along with multifamily, is we're targeting a 5-year hold. If we hit a recession or some sort of snag 2 years in, just continue to operate it for another year or two. You don't want to be a forced seller in real estate, and you can typically kind of ride these things out till you've got a better outcome. But that's high level. If it's debt, it's 10, 11% average annualized return. If it's equity, it's 15 to 20 target. And then deals we've gone full cycle, we've hit 20, 25, 30% on.
Yeah. What do you see as far as, I know none of us have a crystal ball, but what do you talk, I guess, a little bit about the economic factors that are in play right now, and maybe how you see this unfolding over the next 5, 10 years, whatever it may be.
Yeah, sure. I mean, I had ideas in January 2020 about how the year was going to unfold. Those didn't happen, right? So I think as I get older and do more deals, I just like, hey, we're gonna surf this wave. I'm not gonna try to pretend I understand what that wave is gonna do right there. So we're trying to be really good surfers and kind of just ride whatever we're handed. We're a year into a hiking cycle. Historically, hiking cycles are short-lived, meaning, not necessarily multi-year, not 5 years or whatever. I think the Fed has been extremely aggressive, and that's created all kind of havoc for all kind of businesses, right? So they're pretty heavy. I mean, the whiplash of the Fed between COVID to the stimulus to the inflation to the rate hiking, it's just been one big whiplash after another. And so, all kinds of businesses and markets are reacting to that. I would like to think we've got some sort of peak on the rate hikes. I don't know. And I would like to think next year we see some sort of rate reduction. I don't know. So that's kind of it. We're just taking it as it comes. It's never been easy on the acquisition side. And there's just always variables around the debt and everything else. But everybody wants to play ball, right? Owners want to sell, buyers want to buy, brokers need to transact, title companies need to work, attorneys need to work, lenders want to work. So you're going to see and you're already seeing lenders change terms, or, maybe they're going for a longer amortization, or it's lower leverage, but they're going to work something else out. I mean, everybody wants to transact. So you're seeing the market kind of adapt in ways to get stuff done. And at the end of the day, people need a place to live or work. And so that's kind of what we're seeing right now. I would hope we've got some lower interest rate environment on the horizon, but it's hope. I can't say that that's going to happen.
Makes sense. Yeah. What about, I guess, we'll get, right before we conclude, we're getting a little bit long on the time, but, talk a little bit about outside of your work. What brings you joy? I see some of it, I see some of the amazing things that you and your boys do, you and your family do, your daughter. What are some of those things that really kind of make life worth it?
Yeah, for sure. I mean, I just want to be having adventures all the time, right? I mean, it sounds kind of silly and cliche, but a few years ago, building a business is just so hard. It's this idea that I really want every day to be a good last day. And it's not going to be perfect, but you got work and health and family. And I really want to be enjoying what I'm doing all the time. And so I love having a business, and sometimes it's the best thing ever. Sometimes it's the hardest thing ever. That's life. All right. So I do love to work, but I also am really purposeful about my downtime. And I found being like intentional about my downtime makes me better and sharper at work. So my downtime is just crazy. Like, I got into aviation a couple of years ago. So I fly a helicopter it is crazy. But like, for example, the other day I'm like, flew my helicopter downtown where my office is. There's a building we own downtown, land the helicopter on there, walk to work a little bit, get back on the helicopter, fly out, pick up one of my boys, fly out to a ranch and go hunting. And to me, that's just like, feels like a movie, right?
Yeah.
We'll take the plane next week to Belize with the family. Going back to Belize. So aviation has kind of opened up this whole thing of travel for the family. But I love playing golf with my boys. I love hunting with my boys. We've kind of got, my kids are 8, 11, 13, and I'm like very cognizant there's this kind of finite time I have with them, and I just want to load it up with adventures. But I like to play golf and go out with my buddies and go hunting and do that kind of stuff too. So I think just kind of having adventures, and then what that does is to me, it gives purpose to the business to have a big business and have a lot of capital to go do these big adventures, right? And so that's kind of the whole reason I hit a point a few years ago, like, what am I doing this for? I'm not building this to like hand off to my kids. They're going to have to figure out their own way in this life. And so I've found having these bigger visions and bigger adventures is reason to grow the company, which in turn, it's more jobs, more promotions, more opportunities for investors. And I'm kind of looking around and like, well, everybody wants to keep doing more. All the parties participating here want to do more. So let's go big and keep doing it. So that's, just trying to have adventures, man, and keep things interesting. I don't want to slave away at work for a retirement someday. I don't know if I'm going to retire. I just think I want to keep fine tuning my day or my week to be enjoying what I'm doing. And part of that's for sure work, but part of it's family adventures, part of it's adventures with friends, part of it's, flying around the country or the world and just having new experiences.
Yeah, that's great. How about DJE? What's the future hold for your company? Where do you see, maybe a 10-year horizon there as far as where you aim?
Yeah. So our aim is, we've got a set of core values that we operate out of. And so I think that kind of keeps us on track with a lot of things, but our target is to be $1 billion assets under management company. Right now, we're about $250 million, so about $250 million, $240 million of assets that we currently own. And we're always cycling out. We're always adding new ones and selling, but we want to grow that to $1 billion. And so I don't have a hard date on that, but that's over the next handful of years. And then the other thing is just to have the companies forever. So, let's say you've got capital to deploy. You want to deploy it in real estate. Well, somebody's got to manage it. And it might as well be our company. And so I just want to keep growing the real estate portfolio as kind of a family office forever. We also have a foundation that part of the proceeds go to, and I want to keep growing the foundation forever. So, my role in that will change over time, just like it certainly has changed in the past, over the last handful of years, and brought in, more leadership and more everything, accounting and finance and leadership and property management. We brought all those pieces in. And we'll continue to do that to facilitate getting to $1 billion. But, these companies are managing my family's assets now. And I would rather it be this company than another company.
Yeah, makes total sense. Man, appreciate it. It's been a great call so far. But before I let you go, how can people learn a little bit more about you if they want to do an investment with DJE? How do they find you?
Yeah, so the website is probably the easiest. So that's djetexas.com. You can kind of sign up there. We've got a podcast, DJE podcast. You can kind of listen to me, interview guests, get to know us that way. We always invite people to come down to the office and, shake hands. We don't get as many takers on that, but we've had people come from out of state to the office and come hang out. So we're downtown San Antonio on San Pedro Creek, beautiful section of the city just redeveloped. So our headquarters is down here. Welcome to visit. Easiest way though is just that djetexas.com site, and you'll kind of find more there.
Awesome. What about maybe some advice from an investment standpoint? I mean, not everybody, not all of our listeners are going to get into real estate and be hands-on, but if you could do anything different in your own investment career, what would it have been?
Yeah, and I think you got to, as a limited, first of all, education, right? Listening to your show, reading books. I mean, that's a lifelong thing. So kind of embracing that. Sign up to a site like CrowdStreet, start looking at deals. Doesn't mean you're necessarily going to invest there. And I'm not advocating one way or the other, but you start looking at deals. And once you start to see some deals, you start to recognize some commonalities. So I always recommend that you sign up to these crowdfunding platforms. Not endorsing deals there,
right?
But at least you get to see how people are pitching deals, and go run through some dry runs on stuff before you ever write a check. And then I think what you're looking for in a sponsor is kind of a sweet spot. I mean, a very large established sponsor, they might not be taking new investors. Right. A brand new first deal sponsor, I mean, everybody's got to do their first deal, but they might not be well capitalized. You're kind of taking a risk with them, so you're kind of looking for that Goldilocks sponsor that's done some deals, has some full cycle deals, but they're not so big that they're not going to take your $50K investment. So, spending time vetting sponsors, referrals are a good way to do that. If your buddy's got a good experience with somebody, and then education. You might go to a conference and shake hands with some people and meet some people. So there's a lot of education avenues, that are podcasts or reading, but I would definitely encourage getting in a room with some people, shaking some hands, and building some real relationships. And feel free to spend as long as you want researching and getting comfortable before you ever write that first check. I think it's exciting to get in and jump in a deal, and that's fine. It might go very well, but I would leave people with the idea that there's no hurry. You're taking a long-term lens.
Yeah.
Take as much time getting educated and learning about whatever space you want to potentially participate in before writing a check.
Awesome. Well, I really appreciate it. And you've always been very generous with your time, just amazing experience. And so I appreciate that as well. I appreciate some of the time we've had an opportunity to spend together and some of the advice and stuff that you've given me. So, Devin,
awesome.
I appreciate it,
well,
brother.
Yeah. Thanks for having me on, Keith. I really appreciate it, man. And I'm just, there's so many people further, kind of than me that have helped me over the years. And so I think about it like a link in a chain, right? I'm one link. There's all these links in front of me of guys and gals that have helped me. And maybe there's somebody that's further behind me in their journey that hopefully I can help, but it's just a process. So I love talking shop, man. I'm super glad to be on your show. Hopefully some people got some value out of it. And thank you. That was a lot of fun.
Awesome. All right. Thanks, Devin.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.